Hello, and welcome to myfinanceteacher.org. As we mentioned in one of the recent videos, you'll see a link appearing on your screen at the moment. The stock market was due for an intermediate cycle low. After all, the last one happened in August last year, and all the way through December and January, we saw RSI and the stock market a little bit deep into overbought territory. Before we continue, let me remind you guys to subscribe to the channel if you haven't, and click that bell notification. Thanks a lot. Here in late January, when there was a short-term dip, we expected one of the two scenarios. Either that dip was going to translate into an intermediate cycle low, or the market had another daily cycle within it until the intermediate cycle low actually takes place. Looks like the second scenario is playing out, and over the last few days, stock market has lost over 5%. I think over the next few weeks, this dip is going to be a nice buying opportunity in the stock market. However, it's too early to buy anything right now. As I often mention in my videos, these intermediate cycle declines usually give us a lower low pattern. That happened over here in May last year. It also happened at the end of 2018 and at the beginning of 2018 as well. So over the very short term, over the next few days, I think the Fed and Trump are going to talk dovish about the markets to push it up a little bit. That will probably give us this short-term bounce up, followed by a lower low sometime over the next several weeks. And I think there is a nice chance for the stock market to probably retest this 200-day moving average. So at the moment, my target for S&P 500 is somewhere around 3,000 to 3,100. That would be around 9 to 10% drop from the recent highs. That seems quite painful, but if we look at some of the recent intermediate cycle lows, here in May 2019, S&P 500 came back to the 200-day moving average. In late 2018, it was deep below the 200-day moving average. In early 2018, the stock market came down to 200-day moving average again. Among the recent years, only here in the middle of 2017, S&P 500 didn't dip as low as the 200-day moving average. But as you see, in the end of 2016, middle of 2016, and early 2016, the intermediate cycle low either retested the 200-day moving average or even dipped below that. So I personally am looking forward to enter the stock market, but I still think you're going to be patient with the stock market at the moment. Now, keeping this in mind, let's have a look at gold. The ongoing daily cycle in gold is 42 days old. It's not extremely mature yet, so we'll probably still have another 2 to 3 weeks within this short-term daily cycle. So although gold is showing a lot of weakness over the last couple of days, looks like the trend is broken, there is a small chance of prices pushing higher still within the short term. The intermediate cycle is only 105 days old. So after some volatility within the ongoing short-term daily cycle, whether we're going to see a higher high or not, that is questionable. But since the intermediate cycle is not very mature yet, I think there will be a nice bounce later on into the third daily cycle, possibly retesting that 1700, maybe giving us a double top before the intermediate cycle decline takes place. So on one hand, based on the weakness over the last couple of days, I would like to sell some of my gold-related assets. On the other hand, as the intermediate cycle is not very mature yet, I would still want to hold some positions in gold and silver. So while we are thinking about that, let's have a look at GDX. GDX has finally outperformed gold. Within this intermediate cycle, from the bottom to the top, GDX gave us a 22% increase, whereas gold gave us nearly 17% increase from the bottom to the top. So finally, miners are catching up, but the difference between the gain on GDX and gold is not that great. Given the nice move in gold, I would expect much better performance on GDX. As I mentioned in one of my previous videos, in the previous advancing phase of the intermediate cycle, GDX gave us over 54% gain. So again, as I mentioned, gold is a little weak over the last couple of days. That makes me want to sell some of my positions, but I don't want to sell everything, as I think there is still a lot of potential in the ongoing intermediate cycle. As you see at the moment, this is live data in front of you. There is a small green candle again on GDX. It's retesting again the previous intermediate cycle high. And if that resistance breaks, if GDX breaks up from that resistance, the next resistance level above $31, $32 on GDX is going to be somewhere between $35 and $39, formed by these lows that we saw in mid-2012 and early 2013. So again, based on the weakness over the last couple of days, I would like to reduce my positions. RSI has poked slightly into overbought territory. So it looks like the market's opened 20 minutes ago. I might sell maybe a quarter or a third of my positions just to reduce the risk a little bit, but I will still keep 70-75% position because I'm greedy. I want to see if GDX retests this resistance zone. After all, from current prices, that's possibly another 15% gains. I think it is a possibility within an intermediate cycle that's only been going on for 3 months so far. So that's my strategy for the stock market and gold-related assets. Let me know if you think I'm too greedy with GDX. Are you going to sell some of your gold-related assets, or are you a long-term holder? Looking forward to read your opinion in the comments below. Have a nice day and good luck in your trades.